Hi everyone, welcome to our ABFER webinar on capital market and development. Today we are very happy to host a presentation by Ms. Lin Tang on a paper which is really very interesting: large language models and return predictions in China. Let me know if I can buy and sell. And also let me take this opportunity to thank in advance our discussion from Johns Hopkins, Professor Yinan. I know that this after the adjustment of the clock is very late at night. I really appreciate your help. So let us start. Without further delay, Li Tan, please take the floor. 25 minutes, please.
Thank you. Let me share my screen. So good morning, everyone. My name is Tan Ling, and I am a PhD student at the PPC School of Finance at Tsinghua University. And first of all, I would love to thank the ABFER committee for inviting our paper to this wonderful webinar series. And today I'm going to present large language models and return prediction in China. So this is a joint work with Huihang Wu and my advisor, Professor Xiaoyan ZHANG. We're all from Tsinghua University. So in the beginning, people always ask, why do we care about large language models in China? A simple answer has already been given by Sam Altman, the CEO of OpenAI. In a recent global summit, he said that he would expect China to have their own large language model that's different from the rest of the world. We are all the witness of China's rapid development in the AI technology. In just 1 year's time, the number of large language models registered with the Cyberspace Administration of China surges from only 8 models in August 2023 to over 180 models in August 2024. And as we can see from the ecosystem, that the whole picture is getting more and more mature by including not only those general purpose models, but also domain-specific models. And these models come from a diverse set of institutions and sectors, spanning from technology firms like Tencent to financial institutions like Ant Financial, and even to some telecommunication companies like ZTE. So this rapid growth highlights the intensive focus and resources that China is dedicating to this area. And therefore, we're motivated to understand whether this technology evolution could bring about changes in our financial system. So specifically, we're using the Chinese large language models to extract Chinese information from text data. So given all the existing studies on foreign languages, we still need to understand Chinese for the following reasons. The first reason is that Chinese is no doubt important because it delivers substantial first-hand information about the second largest economy in the world. The second reason is that Chinese is quite unique because unlike the other phonetic languages like English, Chinese is ideographic. So it compresses meanings in a very compact combination of characters. So you could imagine that a major difficulty would be to accurately identify the word boundaries based on the surrounding context. And let's consider this example. The sentence 上市公司停牌原因说明会延期, depending on how it's segmented, it could mean that the briefings on the company's trading suspension reasons is delayed, or the company announced that the trading suspension reasons are going to persist. So this ambiguity highlights why traditional NLP methods that ignore the word boundaries, the word orders, and the crossword relations are going to miss substantial information in Chinese. And that brings us to the necessity of using Chinese large language models. The large language models can handle the Chinese by learning the contextualized representations from the character sequences via its transformer architecture. And because it learns in an implicit and data-driven way, it avoids many limitations of the previous methods. So, given large language models applications worldwide, why do we specifically need to understand Chinese stock market? Well, the reason here is that many previous studies primarily focus on developed market, but China is representing and providing important implications for many other emerging markets in the world, and they remain largely understudied. So the major difference between the emerging market like China and other developed market includes the investor composition. Given the highly prevalent retail investors with relatively low financial literacy, the benefits of using the large language models in these markets could be very useful and high. And moreover, since Chinese stock market is actively developing and seeking for efficiency improvement, so it could set as an important setting to examine whether the technology evolution could facilitate market development. So we hope that our understanding could not only provide implications for the AI's role in China, but also implications for every emerging market in the world. And in this paper, we ask two research questions. The first question is, can the large language models process the Chinese public news and predict stock returns in China? And by answering this question, we can contribute the first comprehensive analysis that uses various large language models to analyze public news in China. The second research question is, do these large language model signals contribute to market efficiency? And by answering this question, we are able to contribute novel insights for AI potentially changing the dynamics of information transmission and investor decision-making in the foreseeable future. And here is a brief literature review. So text data contain rich information for forecasting returns, forecasting volatility, proxying for business cycles, and so on and so forth. And recently, the advent of large language models have provided many new possibilities. For example, Chen, Carey, and Xu, they select many important large language models like ChatGPT and apply to US and international stock markets. But such studies in China are very limited and only looking into the BERT-based models without considering a universe of newly developing high-tech Chinese large language models. And this is where we hope to contribute to the literature. Now let's go to the details. So our sample period is from January 2008 to December 2023. And the regular data on stock returns, characteristics, accounting are from WAN and SISMA. We obtain our news data from the China Scope Smart Tech database. It contains 28 million deduplicated online news articles in Chinese. And this collection covers almost all the A-share stocks. The news sources are quite comprehensive as well because it is from 966 registered internet news providers spanning from financial media to government website to WeChat official account. And for every piece of news, we can directly see its title, the timestamp, the news source, the stock ID, and the full bullet of content. So, given this data, let me show you how we're going to trade this data by first showing you what models we're going to use. So remember that there's a large quantity of models, hundreds of thousands of them. So we have to establish a set of criteria to choose the models that we will closely examine. And we make these three requirements. The first requirement is that a model has to be trained on Chinese so that it can really comprehend Chinese data. The second requirement is that the model has to be fully open sourced with complete weightings and detailed technical documentation so that we can later conduct our empirical modeling process. The third requirement is that the model has to be influential. And to measure models' influence, we consider two dimensions: influence in the industry and influence in the academic. By academic influence, it means that the model has to be commonly adopted by some existing studies. And by industry influence, it means that the model has to be officially approved. So based on this set of criteria, 6 individual models pass 3 requirements, and they are 3 BERT-based models, which are BERT, Roberta, and Finbert, and 3 domestically originated models, Baichuan, ChatGLM, InterLM. So please let me give a very brief description for each model. The BERT model first comes out in the year of 2018 by Devlin et al. And it sets the foundation for every subsequent large language model. So for this paper, we're using the Google's BERT model, the Chinese-based version. The second model, the Roberta model, it improves the BERT model with higher training stability. And we're using the Chinese adaptation, the XLM Roberta model, which is open sourced in the year of 2019. The third model, FinBERT model, it is a finance domain-specific model. The difference between FinBERT and BERT is that the FinBERT model is trained on financial text data. And for this paper, we're using the Chinese version of FinBERT from Value Simplex, which is open sourced in 2020. The fourth model, the Baichuan model, it is domestically designed by Yang et al. In 2023. The major difference for Baichuan is that it uses the transformers decoder-only architecture, and it uses some special techniques to better handle Chinese phrases. And we're using the Baichuan 2-7B version, which is trained on 7 billion parameters and open sourced in June 2023. The fifth model, Xiaoyan model, its uniqueness includes by using the General Language Modeling GLM architecture. It is designed by ZHANG et al. In 2023, and we're using their GLM 3-6B version open sourced in March 2023. And finally, the sixth model is the Inter-LM model, and we're using the 2-7B version open source in 2023. So you may notice that these 6 different models, they are all different in their architectures and of course providing different results. To synthesize the economic intuitions, we provide an ensemble model by taking the average of the individual model's signals. Although this simple average technique does not necessarily outperform more complex approaches, we think that its efficiency and easiness make it a quite reasonable start. So now we've seen the data, we've chosen the models. Let me tell you how the models treat the data to derive the most important X variable, the article level representation. So this is a piece of news in our sample. And let's take the Baichuan model, for instance. The model first does tokenization and turns this piece of news into 71 tokens. For each token, the embedding process of the large language model turns the token into a numerical vector with a length of 4096. So now the article becomes a matrix of 71 multiplied by 4096. And now the literature teaches us to take the average of these vectors so that the output vector xit with the length of 4096 is the article level representation for this piece of news. And I should mention that the dimensionality for this X is different for different models, and this is the most important X variable to be used in the empirical modeling process. So what is empirical modeling? The purpose of empirical modeling is to construct 2 return predictive signals. The first signal is the Newton signal, which aims to capture the probability of future stock price going up. And here we estimate equation 1. The dependent variable yit plus 1, it is a labeled dummy variable that takes the value of 1 when the next day return is positive and takes the value of 0 when the next day return is negative. The xit is exactly the article level representation for stock I on day t. We're interested in this coefficient beta, and later I will tell you how to estimate this beta. As for the second return predictive signal, the return forecast signal, we estimate the linear regression in equation 2. And here, the dependent variable RIT plus 1, it is a labeled continuous variable that equals to stock's next day returns. And this time, we're interested in the coefficient theta. To estimate the beta and estimate the theta, we first separate our sample into training sample and testing sample. The training sample is from 2008 to 2018, and the testing sample is from the year 2019 to 2023. And here we adopt an expanding training window approach. In the training sample, we estimate beta by minimizing the cross-entropy loss function, and we estimate theta by minimizing the mean squared error loss function. And after we obtain the parameter estimates, we can apply those estimates to the testing sample and construct the out-of-sample return predictive signals. The y hat is our Newton signal, and the r hat is our return forecast signal. So, how do these out-of-sample signals perform? We begin with an out-of-sample fitness check, and we consider 2 measures. The first measure is the out-of-sample accuracy of the news tone signal. It equals to the percentage of correct predictions where the predicted stock price movement direction aligns with the realized direction. If the accuracy is higher than 50%, it means that the model is beating random guessing. We can see from the upper panel that for all the 6 individual models, as well as our aggregated ensemble model, their accuracy are over 50%. And meanwhile, the second measure we consider is the out-of-sample cross-sectional correlation between our return forecast signal and the realized returns. The correlation, the higher, the better. And we can see for all the models, they deliver positive correlations. So to summarize this page, the out-of-sample fitness look reasonable. And now let's directly test the first research question using a quite standard portfolio sorting approach. The majority of news in China are released after the market close. So to make use of the majority of the information, we adopt a trading strategy that is from open to open. And let me illustrate with this timeline. For every piece of news arriving in day 0, we compute its out-of-sample news tone and return forecast for day 1. We put positions at the open of day 1. We hold the positions for 1 day, and then we rebalance at the next market open. So given this daily trading strategy, we can then calculate the returns for the long decile portfolios, for the short decile portfolios, as well as the long minus short portfolios. And let's see the result. And here I'm showing you the value-weighted and equal-weighted long minus short portfolio returns sorted by the news tone signal during our testing sample. We can see 3 patterns here. The first pattern is that all the large language models indicated by these colorful lines, they generate increasingly positive cumulative returns throughout the testing sample. The second finding is that all of these large language models, they greatly beat the market portfolio, which is the relatively flat black line over the testing sample. The third finding here is that you may notice that the equal-weighted returns are higher than the value-weighted returns. And this is reasonable because small stocks are often subject to higher information frictions, which I will discuss later in more details. To give you specific numbers, and here I'm presenting the CH4 risk-adjusted returns for the portfolios sorted by our news tone signal. From the left-hand side, when evaluating the returns, the annualized alpha range between the lowest 38% for the internal LM to the highest 69% for the Baichuan model. And these long minus short returns are both statistically and economically significant. On the right-hand side, when equal-weighted, the returns are even higher. The long minus short annualized alphas range between the lowest 66% for the BERT model to the highest 91% for the ensemble model. So this page tells us that the large language models do seem to extract useful information from the public news that is not incorporated into prices. So you may have this question, where does this return predictability comes from? What does the model exactly see from the news? So here we provide a very basic word cloud visualization of the long portfolios and the short portfolios. On the left-hand side, the positive cloud is associated with some favorable key terms, such like the word 激励, meaning stimulus, the word 投资, meaning investment, and the word 同比增长, meaning year-on-year growth. And these keywords are signaling positive company development. But on the right-hand side, for the negative cloud, it contains words such like 减持, shareholder sales, words like 亏损, losses, 披露, disclosure, and these words sometimes signal bad company development. So from this visualization, we can see that the models seems to capture both explicit financial indicators as well as some subtle linguistic clues. So now let's get to the second research question. Do these model signals contribute to the market efficiency? To answer this question, we proceed in 4 steps. The first step we take is to understand what's the specific information content that the models help to discover from the news. Remember that Tedlock once suggests that the news conveys important fundamental information about firms' future performances. So it is possible that the large language models might help to review the fundamental information from the public news that is not incorporated into prices. Empirically, we test this hypothesis by using equation 3, where the dependent variable is the future SUE. It is defined as the year-over-year change in quality earnings divided by previous 8 quarters standard deviation. We're interested in the coefficient A1. If A1 is positive, it means that the model can predict future fundamentals and help to reveal the fundamental information. We can see from the table that the coefficients A1 for both two signals are significantly positive, and that supports our fundamental hypothesis. So even if the fundamentals, which may be hard to observe, can be helpfully revealed by the large language models, the market's ability to efficiently incorporate the information might still be subject to information frictions. So we have the economic intuition that the models can be more useful when the frictions are higher, creating more barriers for investors to acquire or process the information. And more specifically, the frictions could be higher when there is more retail investors, because they tend to have limited attention and limited financial literacy for more room for mispricing. The frictions could be higher if the firms have smaller sizes because they tend to have less transparent information background. The frictions could also be higher when the news are more complex, containing some form of uncommon characters, making it harder to understand for the audience. So corresponding to each of the three characteristics. Oh, thank you. Thank you for reminding. So corresponding to each of the three characteristics, we sort stocks into 3 subgroups. And we show that the annualized returns are 20% higher for stocks with higher retail holdings, and 50% higher for smaller stocks, and 50% higher for more complex news. So to directly assess the level of market efficiency and give you a number of news assimilation speed, we test when holding a strategy using already released news could steer on positive outcomes. So here I'm showing you the value-weighted annualized returns for a portfolio that's as a function of the holding horizon. And at the aggregate level, as indicated by the green column, you can see that the returns show a decaying pattern. They are the highest on day 1, they largely decrease on day 2, and they diminish to 0 since the 3rd day. In other words, we can interpret that the general assimilation speed is about 2 days. But across the market caps, things are very different. For the small cap stocks, their returns are consistently stronger and more persistent than the large cap stocks. So the assimilation speed could be effectively prolonged if the frictions are higher. So finally, as the 4th step to our second question, we try to understand whether our large language model signals can help certain investors process their trading decisions. So our economic intuition is that when a piece of news becomes public, the more sophisticated investors can swiftly identify it, act on it, and trade in the correct directions. But on the other hand, for the less sophisticated investors, due to their limited literacy or limited attention, they may trade in the wrong directions. So to proxy for investor sophistication, we rely on the trade size algorithm and separate trades into 4 groups. We consider small trades, which are lower than 50,000 Chinese yuan. We also consider large trades and extra large trades, which are larger than 1 million Chinese yuan. For each group of the trading, we calculate the order imbalance, which means the trading direction for this specific investor group on a certain stock on a specific day. And then we use the model signals to predict the next day trading direction of different investors. We can see that there is a sharp contrast between different investors. For the small retail investors, their coefficients are significantly negative, meaning that their future trades are negatively associated with the large language model signals. So they seem to not be able to trade correctly on their own decisions. And this is exactly where the large language models can come to play an essentially critical role by helping them to process information to trade correctly. But on the other hand, for the extra large traders, their future tradings are positively associated with the large language model signals, meaning that they can profit from such a trading strategy. And before I conclude, I hope to mention that while our primary focus is on the economic implications, we do consider the practical implementations of the realistic transaction costs, and our main results remain robust and practical after these real-world frictions. So, conclusion. In this paper, we ask two research questions. The first question is, can the models process the Chinese news and predict stock returns in China? The answer is yes. And as for the second question, do these model signals contribute to market efficiency? We provided quite comprehensive analysis. We showed that the models, first, reveal fundamentals. Second, they help to overcome information friction. And third, they may help certain investors, especially those at disadvantages, to help conquer their information disadvantages and process the public information. So all of these results suggest that artificial intelligence, like large language models, could be a useful tool for altering investors' trading decisions and elevating the market efficiency. And we hope that our findings can not only provide implications for developing fintech in China, but also for every emerging market in the world. And that's for today's presentation. Any comments would be very much appreciated. Thank you.
Thank you, Nathan. And Professor Su, we look forward to your help for us to understand better the paper. 25 minutes, please.
All right. Let me share my slides. You see the screen? Great. All right. Thank you very much for having me to discuss this very interesting paper in the ABFER webinar series. I know this is a very high-profile occasion. And this is an equally very promising paper here. My name is Yinan Su. I'm from Johns Hopkins University. All right. So starting from the big picture, let me hide this. Hold on. All right. I want to start from the big picture that says information is such a central concept in finance, right? So we talk about common knowledge, we talk about efficient market hypothesis. Those are all about how information is incorporated into the price, right? So like when Fama first started writing about efficient market hypothesis, he's all thinking about news, right? News this, news that, but he never wrote, I don't think he has ever written a paper using textual news data. The reason is he didn't have the tools at that time that we have right now, like the language models to process that data. So previously, most of the finance research are focusing on quantitative data, all right? But the idea is all about information and news. And in a way, language is a prominent way to convey that information in the securities market. We have conference calls, we have financial reports, we have news. All those are like a carrier of that information, right? And so now, but in the traditional efficient market hypothesis, you don't need large language model for efficient market hypothesis to work. The logic go through with human intelligence. As long as you have an analyst reading the news and think about how will that affect the business, how will that affect the profit, and then think about how to price that, efficient market goes through. Now we have this new tool, a machine that can read news for the first time in human history. How is that going to change the way that information is going to be incorporated in price? And that's a very profound, a very important question. And I think this paper is asking these very important questions in the Chinese market, right? So it's going to change how information is processed and incorporated into asset price. And also, I think with these tools, I want to argue that really allows economists to study finance with a very different angle. It's actually an angle that's very classic. We should have done this long time ago. We should have looked at the textual information. The only reason we didn't is because we didn't have the tools. But now we have these powerful tools that allow us to do finance research in a very different way. And I think this paper is attacking this important topic. It's really extensive analysis in the paper. The paper is quite dense, and I think it's done in very high quality fashion, and it's very interesting read. And I'm going to cover some small part of it, but I highly recommend everyone to read it if you are interested in this kind of topic. And I also want to say, Tanlin, your presentation is also very clear. So congratulations on getting this big work.
Thank you.
Yeah. Okay. So I want to take a step back and think about the big picture. So we are trying to explain price movement with textual information. So theoretically speaking, how much should we be able to explain, right? So in the ideal setting, presumably, if I'm explaining concurrent price movement with news, supposedly I should explain almost 100%. This goes back again to very old ideas. So this is AFA presidential address in the 80s. Richard Rowe's R-square, famous R-square paper. Right? It says, if someone is reading this news and they're pricing, the market is pricing assets according to the information, according to common knowledge, then as an economist, supposedly we can replicate this process by also reading the news and then think about, okay, how this news translate to price change, right? Supposedly with exposed in hindsight, we should build a machine that almost give you 100% R-square. But in practice, we know we are really far from that, right? So they call it astronomical degree of accuracy, right? But finance is not there yet. It's not like astronomy where we can predict how the astronomical bodies like stars move with almost 100% accuracy, right? So that's for concurrent price, explaining concurrent price. For predicted price, especially like in this paper, predicting 1 day into the future, we kind of expect like 0% predictability, but that's just because efficient market hypothesis. If people know this is good news, price is already high, tomorrow I can now predict, right? All right, so that's ideal setting. In practice, all right, where is our status quo of our research, right? I want to cite, again, a very related paper that they do a very similar study with international data, but no Chinese A-share data. They say, okay, textual analysis in finance and economics still tip of the iceberg, right? It still cannot fully replicate the human intelligence in reading news and think about how to do that price. But this is a very promising agenda for future research, and economists gradually expand our source of text corpus and increase our ability in using better and better large language models to elicit information from that text. So I think this paper is exactly doing that. They collect a large amount of Chinese text, use large language models that are state-of-the-art for analyzing Chinese language. So it's pushing in this direction. But still, we are still at the tip of the iceberg. We cannot explain 100%. We are far from that, right? So this paper mostly think about the predictive setting and think about, okay, how can I predict tomorrow's return? The big surprising answer is we can predict that more than 0, right? So it's not perfect, it's not unpredictable. Or if you think about predicting up and down, it's more than 50-50. It's like 51-49, right? That's huge. That's huge because we are doing stock level daily returns. If you can just do a little bit better than 0, 1%, 2% R-square, that translates to a huge, very profitable trading strategy. So they show something like 60% per year, right? After adjusting for risk, right? So if you think about a quant trading strategy, that's like a star quant trading strategy, right? The economic implication, immediately we can conclude, okay, the prices are not efficient, not perfectly efficient. It's in some way inefficient, right? So information is incorporated into the price a little bit too slow, right? It takes 2 days for the information to go there. So it's some way it is inefficient. That's the conclusion we can draw immediately, right? So to summarize the paper, they make mainly these 2 points. One is about, okay, they can predict and it can yield a profitable trading strategy. This is almost like a statistical point. And then they try to make an economic point and say, okay, this has something to do with efficiency. With large language models, we can improve. Potentially, we can contribute to improving the market efficiency, right? So I want to quickly summarize these 2 points. First, on the statistical point, how is the forecasting done in a very stripped down fashion? There's 2 steps. Step number 1, you want to translate text, words, Chinese characters into numbers. And this is done through so-called embedding. So for each piece of article, it turns into a vector of numbers. This vector is actually, it's a fixed length, but the length is pretty long. For some model, it's more than 1,000, I think 1,500 for like a ChatGPT kind of models. All right, so now each article becomes a vector. And then we link news article to stock day, label what stock, what day, what time that is. and then basically run prediction, a high dimensional prediction, because the predictors are 1,500 predictors. So it's really high dimensional, right? Run tomorrow's return daily stock level on these embeddings. And then this part is similar to other predictive exercise in finance. All right. For the second point they've made, it's implications on market efficiency. They show 4 supporting evidences. For example, large language model signals can predict future earning surprise. That's the SUE, right? And then it contains fundamental information. And then this predictive power is heterogeneous in different stocks. When you have a lot of retail investors, the predictive power is stronger, right? Some supporting evidence like that. And then they conclude or made this suggestion that this evidence is suggestive of that the large language model signals are helpful in processing public news, and potentially is helpful to contribute to the overall market efficiency. So this is a little bit like a normative statement, as if like I'm Chinese SEC, CSRC, I want to improve market efficiency. Okay, I can ask people to adopt large language models, right? If I want to interpret it this way, I can draw such a policy implication from this claim, all right? So my discussion points also are about these 2 general points that they make. First, I want to talk about the point on implications on market efficiency, and then I have something to say in general about how to use these technologies for finance research, and then connect to some of my current works that I'm doing using large language models. All right. So number 1, the first point I want to say about market efficiency, the implications. These are suggestive evidence. So the findings, right? The facts is that they can predict. From this fact, we can draw some implications. Number 1. Market is not perfectly efficient. Okay, I get that. That's pretty obvious. We show empirically in this way it is not perfectly efficient. And number 2, I think immediately it implies that investors can make money by applying the large language model signals. I'm sure you guys, know that there are quant funds in China that are doing this. So it's not a secret that they are trading on this, and some of them are pretty successful in terms of making a huge amount of profit. Number 3 is a little bit like a suggestive evidence. They say large language model application can contribute to the overall market efficiency. I want to say we can think a little bit harder and more detailed in a more concrete fashion about how this technology tool, essentially is information tool, contribute to efficiency. What steps do we take to go from here to here? How should I interpret this claim, right? So the paper has this writing in the abstract that almost implies that this is going from retail investors. It's reasonable to expect that retail investors have difficulty processing public news, and there's difficulty trading that. So by rapidly analyzing and disseminating news, large language model can play a role in accelerating this process of information. So here are my thoughts, right? Let's take a step back and think about, okay, let's say the market, whatever market, let's say the Chinese stock market in some way lacks efficiency. It's not perfectly efficient, right? Well, it's not a huge claim. People probably believe that. Is that inefficiency due to the fact that we don't have large language models? Or is that because some other market frictions? Because regulation, because the market structure, because is there market manipulation, all kinds of other stories? Or is there sentiments, is there behavioral reasons? The investors are trading animal spirit. So this is almost related to people say there's a contrast between artificial intelligence and natural stupidity. Which one is playing the role here, right? Maybe natural stupidity is playing a bigger role in the lack of efficiency here, right? And also, you don't really need large language model for market to be efficient. As long as you have someone to read the news, make inference, trade on that, market clears, the logic still go through, right? The only difference large language model makes is make this process supposedly faster, right? So how the use of large language model can improve market efficiency, right? So I want to say, I think large language model, like the model that you showed, is almost like a quant trading strategy. I don't think that's likely for retail investors. I mean, I myself probably cannot, you guys are pretty good at coding this, have great data. I myself probably cannot do that. But if you want to start an institution and trade on this, I'd be happy to invest in you guys. But for myself, I probably cannot do that. I just don't have such a large AUM to justify the cost, right? And so this is probably going to be adopted by sophisticated institutional investors like hedge fund, quant trading, right? Those kind of players. Essentially, the role it plays is make this process of information processing faster. Like your paper says, it takes 2 days for the signal to be incorporated into stock prices. But let's think about it. After 2 days, let's say the price is like the signal is already in the price, or the price is right. So you are training your model with that future return as a supervised label. So your model training still relies on that 2 day in the future price. Where does that future price come from? It is slow. Yes, it is a little bit slow, but it still relies on human reading this, human analysts trading on that. It's slow, right? It is slow, but still someone did that job, and you train your model to learn from that human job, right? So it still requires trading and marketing for that price formation process to take place. And also in this process, probably there's going to be other frictions like limited arbitrage capital, right? So those hedge funds that can use this to accelerate the process, they don't have a deep pocket. They cannot trade. They don't have a deep pocket. They have limited amount of capital. So they even if they themselves make a lot of money in terms of return, but the market power of them might be small. Even if they are big, after they are big, the profit is going to be lower because everyone else is also fast. So then it becomes a statistical arms race, right? So those people who make a lot of money must be the small pocket of people. It's a small amount of capital can do this, right? Large amount of capital, they're still a little bit slower than the most cutting edge people, right? So those kind of frictions are still going to exist. Not sure to what extent that's going to what extent that is going to really translate into efficiency improvement, right? It depends on how much capital is equipped with this kind of technology, right? So this is related to a recent working paper that I've been thinking a lot about. This is titled as Quantity, Risk, and Return. So we kind of think about this interaction in the market between sophisticated and noise traders, right? So yes, there are sophisticated investors. They're smart, they understand factor pricing, but they're not everyone, right? They're only a small amount of people. There's a huge amount of noise trading, and this noise trading from retail investors are going to exert a price impact, even if you have sophisticated investors. So we bring these two players together, and we can incorporate this quantity information from market trading activities to the traditional factor models and make the factor models much better than the traditional factor models without talking about quantity. And we can do return prediction at an accuracy that is comparable with machine learning tools, right? So this is some related work that I'm thinking about. Thinks about you have sophisticated versus retail investors, right? So I think today's webinar's name, it's a series called Capital Market Development, China and Asia. It's really a great occasion to think about what are AI's role in terms of capital market development. So here are some of my thoughts after reading the paper that I got inspired. I think the development is probably we're going to have some highly profitable hedge funds. I put quotation marks here because I'm thinking it's not traditional hedge fund. It might be some very smart computer science students that are doing this in their dormitory. They don't have a huge amount of money, but they are highly profitable in terms of return, right? So they are really cutting edge, right? So they can use, you can code very fast. They can use the very new models, right? I don't think the large institutions, the ones that are really has a big price impact, they have a huge AUM, are at the front, at the really the cutting edge. Even if when they are, they probably will drive down the profit, right? So there's some small pocket of leaders that are going to adopt these tools, right? So that's for the practical perspective. On the other perspective is economists, like from our perspective, we can better learn in what ways the market is inefficient with the tools you presented, right? You can say, okay, in this segment of market, the Chinese stock market is really slow in incorporating this information. Somehow people are not reading this kind of news. Somehow those kind of news are always very fast to incorporate into price. Is it WeChat official account? Is it the traditional newspapers? Maybe you can say things like that. And that has a great potential for policy impact. And you can say, okay, if we do something here, we can improve market efficiency here, something along this line, right? So I think this is very rich opportunity to harvest this very rich data from news, from textual data, and use these new tools to basically replicate how humans are processing this information in the market. And then we as economists can go back and look at history, news data, and plug those data into the traditional ways we do finance models, right? So this is a very great way to enrich the empirical studies that we have already doing in the finance academic research. So one paper that I did in this field is called narrative asset pricing. So this is already a published work. What we do is we build news using Wall Street Journal news, and we build state variables from that news. So state variables, like in Merton's ICAPM term, state variables, those, if you read Merton, it's all about news. Okay, I have news that are forecast the future, but they never actually use literally news from the newspaper. So we use that, and we can actually improve the traditional factor models in the ICAPM model. The model performs better empirically. All right. So that's my point about efficiency and how to use this to advance our research. Okay. My second big discussion point is about this application of these tools. So my second point is going to be a little bit more technical here. And maybe not exactly related to this paper. I'm thinking broad and large. So I want to just kind of put large language models into two categories and then talk about their different applications. Roughly speaking, I can put them in these two categories. One is models that are used for text generation. So this is basically your ChatGPT, your chatbot, your creative writing. You say something, they say something back. You keep saying something, they say something back. The output of this kind of generation models are text. All right, that's one kind. The other kind is embedding large language model. The output of these models are numbers. They're numerical vectors. The purpose of the embedding model is to translate text into numbers so that you can do downstream tasks. You can use the numbers to do machine learning in the old-fashioned way. So this paper is using the models in this fashion. They're using the large language model as a way to translate articles into numbers and then plug into a machine learning framework. That's great. Under the hood, these two types of models, they have a lot of connections. Under the hood, the core of the transformer network might be even the same, right? But the output here for the application is different. This one is directly for customers. The output is text. This one output is numbers. It is not directly for human use. It's still plugged into a machine use for machine learning. All right. So still, one can extract vector embedding from text generating models. So this paper is kind of using the models from this category, and but they use the neural activations to extract numbers as if they're embedding models. So maybe a small thing to say here is that this paper can directly use embedding models because those models are directly optimized for the purpose of downstream machine learning. But anyway, under the hood, these two kinds are very, very similar. And then I want to talk about how to use these two kinds of models and use for different learning techniques. All right. So the learning of predictive models in this paper, let's think about it. It is still high-dimensional estimation. You're still running a regression of tomorrow return on high-dimensional embeddings. This regression, you still require a lot of data, many stock day. So it's a big data application, basically machine learning. So in this sense, it is quite similar to traditional quantitative prediction, the prediction models we learned in finance. It's not that different from using compute-stat quantitative data. It is still quite different from how humans read news. Humans read news, humans don't learn by looking at a huge amount of data, right? So they learn based on knowledge, and the knowledge that they accumulated that are transferable to new situations. I have a new news, but I can use my old knowledge to interpret the new news, right? So with these large language models, we can sort of be more human-like, right? So this is the thing I want to mention called zero-shot learning. I'm sure you guys are familiar with this, but I want to point out it's very different from this statistical learning paradigm, right? So this zero-shot learning, you don't need to go to a huge amount of sample for like a machine learning training. Basically, every new piece of news comes in, I can ask the large language model, okay, read this piece of news. I just say prompt. I just use prompt. Read this article. Do you think this is a bullish or bearish news? Do you think the stock price will go up and go down tomorrow, right? So that is so simple to use, right? And there are some papers that show even this very simple approach to some extent works. So I think this kind of a prompting approach has the potential for retail investor adoption. Retail investor probably can use prompt. They just ask a news, if you can build a better website, build a better interactive user interface, you can let users, retail investors, to interact with a large language model, help them interpret news. So probably this is the potential for industrial applications for investor adoption of large language model. But another way to do zero-shot learning is something that I'm interested in, is using embeddings plus cosine similarities to do that. So basically, we can just embed all the news in the history, and then every time I ask, okay, are these news going to be positive? And then I just embed another English or Chinese query that says bullish, just this word, or optimistic, or growth, or positive, and then I can calculate article level forecast as a semantic similarity to that query. So which article is similar in terms of embedding to this word bullish? If this article is similar to that, okay, that gives me a high similarity score. I can probably predict tomorrow price is going up, right? So this allows a huge potential to do things that are very different from the traditional statistical learning framework. So I have this picture for semantic similarity. I'm going to skip this. So this is some tool that I am building now. It basically allows a user to query any topic that you are interested in. You might be interested in bullish. He might be interested in artificial intelligence. I might be interested in climate change. I just type that as a human supplied query. I hit enter. I'm going to calculate cosine similarity with all the articles in my database. And then my machine will output a attention index over time. All right. Sometimes you talk more about climate change. Sometimes you talk more about Bitcoin, all kinds of topics. And we want to build this web-based service. We have the website. We're going to put that live for all researchers to use. And you can query whatever research topic that you are interested in. And I give you attention series that's built from Wall Street Journal data or whatever other textual data I have. I want to show some examples. So here I'm just querying recession, right? Sometimes the Wall Street Journal talks more about recession, sometimes less, and we can replicate an old way to do this very closely, right? So this is querying recession. This is querying ESG. It tracks a Google trend of ESG. This is kind of interesting. We're querying financial stress because Office of Financial Research, they publish this financial stress index, right? But you can see their index is kind of low frequency. But now I use this query method. I just query when the newspaper talks more about financial stress. I can to a large degree replicate that time series with a higher frequency. So maybe this is something that's great to use for all kinds of economics and social science research. So I guess that's the end of my my time, and I want to use just kind of show this my potential research, and with that I want to conclude the discussion. Look forward to talk more with you guys, and look forward to meeting you in person in the future as well.
Well, thank you, Yinan. I learned so much from your discussion that I did not have the heart to stop you. I gave you extra time because it's so wonderful to have all this analysis and explanations to help us to understand the subject matter. Thank you very much. I wonder if two things. Number one, for those who have questions but not amount on our Zoom arrangement as a panelist, please type your question to Charlie Tang, and we will try to accommodate your question as much as we can. And then Li Teng and the other Xiaoyan and your other co-author, I want sorry, somehow I just stumbled. But all three of you, I'll give you some chance to respond. But maybe let's see if we have any further questions. Let me take the liberty to ask the first question. Okay. Stimulated by Yinan's discussion, I'm kind of wondering, what kind of inefficiency is optimal? I can think about the efficiency and inefficiency, the ability to predict, and so on and so forth. At the same time, the cost in running this LLM model. I mean, the energy costs, all this are non-trivial. And will this very high frequency catch up of the price of value really change the long-term resource allocation ability of the market? So this is my question. What's the cost and benefit? The second question I have is really, I feel that there's a paradox here. Using the LLM model, we can, as Yinan suggested, we can track down to what extent is human. Let's think of the human trading as the organic component of the market and LLM as the mechanical inorganic component. And putting the two together, the mechanical inorganic component can track down the inefficiency of the organic component. However, if the two interact, then the distance will become less and less. So what is the feedback effect, and what is there a paradox when we all use the LLM? We may get into a kind of pricing trend that may actually be inefficient. I'm done with my questions.
Well, thank you, Bernie. And thank you, Yinan, for the excellent discussion. I'm taking the lead on this one because I feel like in the presentation, when we put together the PPT, we probably didn't emphasize enough about inefficiency in China. In the United States, we have tons of institutional investors, and they provide the function of price discovery and information efficiency. But China is quite different. We have been working with Chinese data for a long time, and 70–80% of trading volume.
So Ian, sorry interrupting you.
Yeah.
Would you mind to raise your voice a little bit, or the microphone?
Can you hear me?
Somehow, because of my poor reception,
Okay. All right.
Thank you.
Thank you. Sure. So what I want to say is, in the presentation, we didn't emphasize enough the difference between Chinese market and other developed market. And this market has 70–80% of trading volume coming from retail investors. So when we talk about Chinese market inefficiency and how large language models can be helpful, what we had in mind, but we didn't have time to talk about, is retail investors' dominance and their behavioral biases, and they fail to process public news. They react to a lot of non-fundamental information, and they cannot fully process what is really in the news. So that's what we meant by, how large language models can contribute to price discovery process and information efficiency. But obviously, we can do more. We can do more. And I don't think this question has been raised before. You want to separate your paper from the previous paper using international data, mostly on the developed market front. We should dig in more. So thank you for the feedback and Bernie's first question. And what kind of inefficiency is optimal? That's a philosophical question. Like Yinan mentioned, what is the optimal R-square, right? 100% or 0%? I think right now the CSRC is trying to make sure the information environment is as public, as transparent as possible. It's more like the Reg FE in United States. The information environment in China is not particularly optimal at this point, but in terms of how much inefficiency is optimal, we leave that question open. What we're trying to say is, given the public financial news, we hope the investors can get the right interpretation from those news. And I also like, Bernie, your second question about, can we use large language model to understand which part of the information is mechanical and which part is human, and how about the interaction between human and machine? I really think this is the frontier of the literature. There have been several teams working on this project. I think, you probably are working on that as well. But right now in China, it's not, in our paper, not yet. But I do think it is very important to understand the interaction between human and the machine and the behaviors the machine is changing, how people behave. Again, let me emphasize again that we have a large retail group in China. Most recently, given the government stimulations, there are a lot of reactions to it. Sometimes it's overreaction. They don't necessarily understand what the stimulation is about. Sometimes there's overreaction. Our large language model hopefully can help a little bit on this front.
If I may, just there's something in my mind, and I really want to get the panelists and the audience to help. Suppose we use LLM, and as suggested by Yinan, we can use that to track down the inefficiency. As if at the end everyone use LLM, assume that somehow it's for free, assume that it's costless, everyone use it. Then using the LLM to track down inefficiency, we find that, the market is perfectly efficient.
Yeah, it's not predictable.
But does that mean that the resource allocation is
the best?
Better?
Not necessarily. The traditional market efficiency hypothesis says if there's any information that can predict return, right, that's from pharma, and then it's not efficient. So informational efficiency actually tells you there's not much predictive power. But to get to the point of optimality of information processing, I think that's we don't answer. We probably can do something about pricing errors, whether it's some particular assets are overpriced or underpriced against their fundamentals, that can be done as well. But the informational efficiency and allocation optimality, they're two dimensions.
They are two dimensions, right? Yeah. Yinan, do you have any input on this? And also, I would like to draw the author's attention to a question in the chat box. Can you elaborate on the news information source? Are the news aggregated and disseminated in real time and accessible to everyone? So, Yinan, any input from you on this efficiency, the two dimensions of efficiency? Any insight from you? And then the author's answer to the question posted, please. Yinan, you go first.
So in general, I very much agree with what Professor Zhang just said. I think in general, the direction is we're still, I don't know what level is optimal, but I think we are suboptimal in the direction we want to make it more efficient. So I think that's a consensus here. And I understand very much that there's a lot of retail investor-driven inefficiency, right? So supposedly with these tools that there's potential for improvement and for contribution from these tools. I'm totally on board with that. And I would leave the authors to answer following questions.
Thank you, Professor Su. Please let me take the lead to answer the question on the news source of the information. I'm happy to answer this question because our news is quite comprehensively sourced. It is from nearly 966 registered internet qualified providers, and it covers three main sources of news. So the first source is from the financial media, like Sino Finance and like East Money, and those sources of traditional financial media. And that's source number one. So news source number two is from the government website, such like the State Council and those official websites. So news source number three is from the WeChat official accounts. for brokers, for mutual funds, and they open some of their so they open up their channels for communicating with the investors on the WeChat official account, and their news are also collected in our information source. So the source contains 3 groups of information platforms. So as for the second question, are the news aggregated and disseminated in real time and accessible to everyone? The answer is yes. Well, the news are not the news are aggregated by the data provider. But for each of the constitute news provider in our database, the news is disseminated in real time, and it is accessible to everyone who have access to online, the online access to who can access the online news. They are directly accessible.
Well, let me clarify a little bit more. The news are not aggregated from when they are first released. They are released in real time. It is publicly accessible, but it's up to individual investor to aggregate. When we receive the data, it's aggregated at a data set level, but all those news are real time and accessible, public news.
Okay, thank you. Huihang Wu, the co-author, is anything you would like to add before we close?
No, thank you. Thank you very much. I have nothing to add.
Yeah. Well, let me take this opportunity to thank all the authors, the presenter, and the discussions. I'm very, very stimulated by this wonderful seminar, and I hope to see you all again on December the 19th. We will have Beijing time at 10 a.m. again, December 19th. We'll feature Jiguo Hei's paper together with Libo Liu and Fei Chiu on share pledging in China, funding listed firms or funding entrepreneurship. It promised to be another exciting webinar for us all. And last but not least, really, Yinan, thank you. It's past midnight time, and thanks for staying up and work with us. Thank you, everyone. I really enjoyed this, and see you again on December 19th.
Thank you,
Bye.
Bernie. Bye.
Very much. Thank you. Bye.